Hi there, it's James Marley here, Executive Director at Livewire Markets, and welcome to another one of our CIO Profile series. I'm joined today by Scott Haslem, who's the CIO at Crestone Wealth Management, one of Australia's largest wealth management firms, overseeing close to $16 billion in client funds. Our discussion today talks about his views on the big picture from a macro perspective. He gives us an insight into how he's thinking about asset allocation and constructing portfolios, what constitute risks in portfolios and how he measures that, and then we get into a few of his current views on some of the big things like housing in Australia, the US dollar, and the job ahead of the RBA. I hope you enjoy the interview, so let's get into it. I always like to warm things up with a bit of a story. Could you give me maybe an insight into a particular moment or a story from your career that's had a big influence on you and how the way you think about investing today?
Well, I think two things come to mind. The first one is where I started as an economist, straight out of uni in the middle of the 1991 recession at the Reserve Bank of Australia. And it's just a fantastic training ground where you spend a lot of time doing one thing. So you might spend 6 months looking at consumption or 6 months learning about the labour market. And so you get quite an in-depth look at each particular part of the economy and how it works. So when I think about that influence and working with people like Glenn Stevens and Ian McFarlane, Bernie Fraser, all deep thinkers, that idea of really understanding how something works, the analysis and the detail, I think has been critical to me in how I look at investing, making sure I know what I'm doing and I understand how all the things work together. And the second is sitting in a hotel room in London during the global financial crisis, watching the Dow at the time down 1,200 points, which is almost 5%. And that idea that you have to, as an economist or as an investor or as a chief investment officer, you have to be able to evolve. And things change in the world. And I don't think many economists knew what LIBOR was back in 2008, and so we have to be able to adapt and learn new things through our careers.
And be receptive to new ideas.
Yes, because the world changes and not everything works the way that it used to work. We'll put as much effort as we can into figuring out why things are working the way they are, but be open to things not working, whether that's, why aren't we getting more inflation when we've got really strong growth? Those type of issues are really important in thinking about investment markets.
Yep. Well, we're going to get into your views around investment markets today. Before we start on your framework for thinking about investing, could you give me a sense of the sort of investment objectives or the mandate that you're trying to hit in your role at Crestone?
Well, what we're trying to do is most of our clients are either high net worth or ultra high net worth individuals. We also have a lot of faith-based, not-for-profit organisations. And so key for us is about building globally diversified investment portfolios that protect wealth and create returns through the ups and downs of the cycle. So we're really trying to make sure we're providing the best opportunities for our investors across a pretty wide range of possibilities.
Okay, so if we're to start, before we even start putting the nuts and bolts into a portfolio, what are the factors that you look at to influence how you start to compose a view of how you want to be invested at any point in time?
Well, given my background, 27 years as an economist, I tend to look at investment markets through a macro lens and thinking about the economy and valuation from that perspective. Ultimately, a company's share price should be a reflection of its earnings, and companies work in real economies, and so the economic backdrop is pretty critical in my thinking. I don't have a particularly long attention span when thinking at things like technicals, or they don't really influence me too much. So I tend to think about the macro more than sort of flow in thinking about those things.
And when you look across global economies at the moment, can you give me a quick temperature check on how you see the world and global economies, all the different regions at the moment?
Well, one of the things that we're thinking a lot about is where we are in the cycle. A lot of people defer immediately to we're at the end of the economic cycle. The US is approaching, or is not already at, one of the longest cycles in history, and the world is approaching one of the longest market cycles in history. So one of the key issues is, where are we in the cycle? We tend to think we're not quite late cycle yet. I think it's pretty fair to say we're later cycle. We're clearly closer to the end than the beginning, but we still think the economic cycle's got some way to run. So global growth accelerated very sharply last year, went from 3% to 4%. That's a 30% increase in growth momentum, and we saw that in equity markets with double-digit returns. Growth's not accelerating this year, but it's still really strong at 4%. And so the US is growing above trend. Europe, whilst it's a bit slower, is still above trend. Japan produced a really strong second quarter GDP number. So it feels to us that we are later cycle, but it's not over yet. So we still favour equities over bonds. There's enough growth that as we exit this grand experiment of quantitative easing, that central banks are going to reduce liquidity. Interest rates are going to start to rise a little bit. So that means interest rates are returning to something like normal, and therefore we favour equities over bonds.
You've sort of outlined that reasonably favourable growth picture at the moment. As we talk, the topic du jour is the geopolitical tensions, and particularly some of the impacts that it's having on emerging markets. How much weight do you place on some of these geopolitical issues that we're seeing, and are they the sorts of events that have the capability to sort of end a cycle in its own right?
I think they are. I think they do have the ability to end the cycle. As we see it, we've got an improving path of growth, but it's quite narrow, and it's surrounded by all of these geopolitical events, whether that's what we're seeing in terms of Trump and China around trade wars. We have the recent developments in Turkey, but we also have other things in Europe around the Italian government really going to put forward a fiscal plan that the European institutions aren't going to like. Theresa May is struggling with Brexit. So these things, this sort of fits into one of the two buckets of risk we think about. So I would bucket risk firstly as growth just picks up really well, inflation comes, central banks have to take away the punch bowl, interest rates rise, and equities peak and come off. And that's an environment which isn't great for either equities or bonds, and that's why we're sort of encouraging our clients to think about alternative asset classes at this point in the economic cycle. And then the one that you mentioned, which is global growth just falters, it just stops because there's either a particular geopolitical event or businesses just lose confidence that the global economy just slows. That's a very different asset allocation framework. Yes, equities would struggle, but bonds would probably rally quite a bit in that environment. So there's two main buckets of risk. They have different asset allocation outcomes, but it being later in the cycle, we're definitely talking to our clients about being a little bit overweight cash and liquidity, and also thinking more about some of these alternative assets that can protect your downside and diversify your risk in your portfolio.
Talk me through your base case. You've positioned those two risk scenarios. The base case is, I'm guessing, that global growth continues to move along, inflation comes through, and the cycle ends its natural course.
Yeah, look, I think that's how cycles typically end, when they get overheated or you get policy errors. This one, we think, assuming our base case is the next round of tariffs come in from the US, but we don't get a full-blown trade war. And so we end up going through the next year or so with pretty reasonable growth, led by the US. And I suspect at some point the US overheats. The Fed has to do a little bit more, and that is the sowing of the seeds of a downturn in growth, possibly even a recession in the US, somewhere either late 2019 going into 2020. But what we do know is late cycle equities tend to give you pretty good returns, and that's why we're sort of hanging on with an overall neutral position on equities with an overweight to global, because we think that's where the best growth opportunities are, and we're running a bit underweight fixed income because we think interest rates are ultimately going to rise. So that's sort of our central case scenario in terms of how we think things will play out. And so we recently made a reasonably courageous move and went overweight US equities at the end of June, based on just US growth leadership, the fact that my macroeconomics, my understanding of how fiscal policy impacts an economy, that the sort of stimulus that the US is applying, it's going to take longer. It's going to take longer to come out through the economy, and we've seen a nice 4% bounce in the second quarter for the US, and still the recent data says the consumer's doing super well. So we think there's a little bit more to go in the economic cycle, and we think the opportunity cost of moving really significantly defensive at this stage of the cycle, you run the risk of leaving a lot of return on the table.
Yeah, interesting. I know within your global equities allocation, there are a couple of themes that in particular are of appeal. A couple of them that popped out are population growth and energy and technology. Could you perhaps pick one of those, or pick one or two that talk me through the case and why you're so bullish on this?
Great. Technology, we still like technology. We understand that those parts of the market have had very growth in general, and technology specifically has had a really good run. But these companies have outstanding earnings outlooks, and so one of the things we're talking to our clients about is think about what companies you like and making sure we can build them into your portfolios at the right price. So as some of the stocks correct, we would say temporarily, that's the time to accumulate. So whether that's Tencent in the recent falls or Facebook earlier this year, these are opportunities to get the stocks that you think are the long-term growers and put them into your portfolio. And we're also thinking about not only just within that technology space, companies that are technology, but companies that use technology well. So that whole technology theme is pretty important to us, and clearly Australia has not got a big exposure to that part of the market, and so we do like looking internationally for those plays, not only in the US but also in Asia, China, and Europe as well. One of the other themes we like is the EM population growth and the rise of the EM consumer. That's a story we think has going to go on for some time, and particularly in China, large number of companies there that you can access that are linked into that strong growth, that strong earnings momentum coming through the consumer. Domestically, I think one of the interesting things is how you access global growth from a domestic position. So companies like CSL or A2 Milk, these type of companies that are getting global momentum and global growth from a domestic location, I think are pretty important for a small open economy like Australia.
Yep. You've talked about having a tilt towards global equities. You've mentioned a few Aussie names there. What sort of role, or are there any particular areas in the local market where you say that you feel they play a role in a portfolio? Is there a strength in Australia that you like to play to?
Well, we obviously have a core holding in Australia because a lot of our clients' liabilities are here. So we still have big holdings in Australian equities, but we're running tactically underweight that market simply because when we look at the earnings outlook, 4%, versus, say, the US or Europe at 8 to 10%, is just a better opportunity set offshore. So we don't not like Australia. We just think there are better opportunities internationally. And I think one of the issues for me as an economist is when there's a lot of doom and gloom out there about the Australian economy. I mean, I think the Australian economy looks pretty robust. Yeah. We're producing 3% GDP growth. If we look at, we created 300,000+ jobs last year. The unemployment rate's drifting down. The last 3 or 4 months of retail sales been pretty good. Business conditions are near record highs. I think the Australian economy looks robust at 3%. The issue for me is that US is growing above trend. Even Europe, which has slowed down and people are a bit down in the dumps about, is growing above trend. And so you get that momentum in the economy and momentum in earnings. 3% in Australia is trend. That's maybe what we've been doing for a long time. So you don't get the same delta in terms of your earnings and your momentum. And I think the other thing that's interesting in Australia is, if you ask me, well, what's going to drive the Australian growth story? Education, tourism, agriculture, as well as exports and various other places. They're not that well represented in our equity market. It's hard to catch those themes in any magnitude. What we have is a lot of financials, and what we have is a a focus on slowing down credit growth. So it's a much more difficult market, I think, here.
Yeah, interesting. You talked about the fact that capital preservation is something that's really important as a focus for your business and for the investors that you work with. What are some of the practical ways at a portfolio level that you can assess how much risk is in a portfolio that exposes them to potential capital loss? How do you think about that?
Well, I think history is a great guide. So we can look at how equities perform over 50 years and you can derive an average return and an average risk profile. And you can do the same across different asset classes. So from that you can build a portfolio that achieves the risk and return mix that a client specifically wants. And so we know from the academic research that 80% of your long-term return comes on how you build that portfolio. So I know on average what equities are going to deliver through time. I know what fixed income delivers and the volatility around those assets. So it's about putting those together in a way that derives that return and being diversified in your portfolio. And so that's important. I think the other issue is if you're prepared to take the emotion out of timing the market and working with a strategically allocated portfolio, it takes some of the mistakes away, whether that's selling at the bottom, liquidating at the top. I mean, if you look at the S&P 500 today, it's pretty confronting in terms of how it's continued to go up. You can look at the same picture up to the middle or so of 1997 and it looks very similar. If you liquidated at that point in 1997, you missed out on 57% return over the next 3 years. So timing the market is difficult. So part of the whole de-risking process is understanding what you're investing in, the characteristics of it, and putting it together so that it has the right risk-return profile. And we often do that with our clients, put their profiles through models to make sure that they're not paying for more risk than they actually want to receive.
Yeah. So it sounds like taking out some of those emotional biases and those traps that people can easily fall into. Yeah, to let the asset classes do what you want them to do.
We definitely try and enhance return through moving asset classes around a little bit, but much of the return comes from just building an appropriate portfolio for the client's needs and allowing that portfolio to work.
You talked earlier about looking out for potentially keeping people open-minded to increasing allocation towards alternative managers, which are a bit more of a defensive stance. What sort of markers and what sort of catalysts would precipitate a change or a more more proactive allocation towards defensive managers or defensive investments like alternatives?
Yeah, so we're running overweight in alternatives because as much as my central case view, as we've discussed, is that the economy continues on and growth does okay and equities give you moderate returns, there's plenty of risks out there and things can go wrong. So the sort of markers, we sort of set up a number of things we look at in order to keep an eye on these things. So they tend to align a bit with the two risk buckets that we think about. So the first risk bucket was the global economy overheats, we create inflation and central banks have to take away the punch bowl a little bit more quickly than we thought they would. That's sort of looking at things like average hourly earnings in the US or core inflation, whether that's in Europe and the US, and just monitoring whether the global economy is getting a little bit overheated. And so those indicators today look pretty relaxed. We got a bit of a scare at the beginning of the year, and I was reading one paper seemed to suggest that it was going to be a 1994 style bond crisis when we had a little bit of wage and inflation pressure, and someone else said it was a 1987 style equities crash, and it was neither of those things. And so inflation sort of pulled back a little bit over the course of this year, and so we're watching those things. And then the second bucket was around growth just faltering, and so we're watching global PMIs, those leading indicators, which have came back a little bit, and now they've picked up again a little bit. So we're keeping an eye on those in case global growth falters more rapidly than we anticipate, and we're looking at things that cause global cycles to end, policy errors, financial crises, and so keeping an eye on China credit growth to make sure that's not slowing too much as well.
Yeah, interesting. One of the things I wanted to chat about was just the implementation of the thinking that you've got around your investment ideas and your base case. With all of the innovation that's been coming around, ETFs, active versus passive, just be interested to get your view on how you like to go about implementing some of the ideas that you've got around asset allocation. What are your preferred methods, and what's your view on innovation?
Well, I guess with ETFs, they clearly have a role, but I think one of the issues for us around ETFs is understanding how they're getting a handle on the underlying asset is important to us. And I think for a lot of these new ETFs, it's not clear necessarily how they're going to behave through stressed financial environments. They haven't kind of been around long enough. But we certainly look to ETFs to engage some of our tactical views if we want to be fairly timely in terms of accessing a theme like European financials where we think there's steeper curves or some aspect. We certainly are open to utilising ETFs, particularly the more active form of ETF. I mean, I think in some markets, Asia might be an example, or if someone wants exposure to India, these are markets that aren't as researched as extensively as you might be in the US. So you actually we would prefer to pay for a manager who's going to generate alpha in that space rather than paying a lower fee for an ETF that just gets everything, a lot of which we might not actually want or might not be good enough quality. So we do use them selectively and tactically, but they're not a core part of our business.
Yeah, interesting. Do you think they provide? You talked about not having had a sense of how they would work in a down cycle. Do you feel like they're creating a lot of risk, or do you feel like there's, do you feel like they're riskier than perhaps they look, the ETF sector?
I don't know. I think time will tell. It doesn't immediately jump out as me as something that's creating a lot of excesses and financial risk in the way that subprime or any of those type of things did. So I'm much more relaxed than that. But I think we're just not 100% sure how these things will behave. And as I said to you, when we're building portfolios and we're looking at risk over the long term, that's an assessment over the longer term. Some of these ETFs are relatively new. We don't know how investors will behave as they try and maybe exit some of these products. So it is something we look at reasonably carefully when choosing to use a particular ETF.
Yep. On the flip side, in the active space, obviously a really core component of what you do is choosing good quality fund managers. What are some of the really important hurdles or the checklists that you and your team go through when selecting a fund manager? What does it take to find a good fund manager?
Well, we think firstly about alignment. Is the fund manager actually offering something that our clients need as part of their portfolios? So we're always thinking about what the strategy is and do we need it in our core holdings. We think then about active. We really do want active managers who are truly adding alpha rather than paying for beta. So that's important to us. And I think the other things we think about is consistency. Is it repeatable? A lot of managers might have generated return, but is the strategy repeatable? Can we see, is that something that they can continue to do? We think about consistency and of process. Is the manager consistent in how they generate their returns? And are they generating those returns in the way that the PDS says they're generating returns? So they're actually got, this is how we do it, this is what we do, and the returns come from that. So there's a consistent return profile for them. And I guess the last thing for us is risk management. We really want our fund managers to understand or show an understanding of risk management because that's very important to our clients as well. So all of those things feed into whether a manager sits on our platform.
A final question for you. If you had to isolate 3 investment principles that you think are essential or the key ingredients to good investing, what would you list out as some of your core investment principles?
Well, one of them we've talked quite a bit about, which is diversification. It seems odd to me that anyone would put all of their assets in one particular asset class or even investment. No matter how good the return looks and how confident you are about the return of a particular opportunity, you just have to diversify your capital and your investments, because no one really knows how things play out. So diversification is super important. Related but different is asset allocation. Understanding how different assets perform through the cycle and looking at how, when equities go up, typically bonds go down. These are natural hedges that you can build into a portfolio to ensure that you can preserve capital and generate reasonable returns through time. And the third one that I think a lot about is never being a forced seller. I think that's where you can give up a lot of your return on, terrific investments that you spend time thinking about, investing in and managing. And if you get yourself in a position where you're a forced seller, I think that's typically a bad outcome. Another way of thinking about that is making sure that we're not asset rich and cash poor when we're investing, and making sure we can move through cycles and take the opportunities. And so a lot of our clients work with reasonably high cash balances to avoid those type of situations.
Great. I think they're really good principles to invest by. Listen, Scott, thank you very much for coming in, give us insight into how you invest at Crestone, and appreciate your views on how you see the big picture in the macro lens right now.
Thank you.